Welcome to Atcons, the easiest way to explore your journey of investing in stock market. Fundamental analysis. Fundamental analysis of stocks is one of the most popular methods of studying stocks. Investors that analyze stocks utilizing fundamental analysis prefer to look at basic information about a company to figure out what they think is the true or fair value of a company's stock. Fundamental analysts look at a lot of news and perform research into data such as the growth of the company's sales and profits. By comparing the current stock price to the stock's fair value, they believe they can determine if it might be a good time to buy that stock or if it's a stock that they should avoid. Most individual investors use fundamental analysis in some way to pick stocks for their portfolios. If you are looking for a way to build a buy and hold portfolio of stocks made up of companies that you can purchase and then own for years without losing too much sleep at night, you will probably be interested in the methods of fundamental analysis. Economic analysis. Monsoon. Early favorable monsoon is good for stock market. In good monsoon, the country's GDP, gross domestic production, increases. As people's purchasing power goes up, the aggregate demands will go up, companies do well. Their profits go up and investors get higher yielding. The impact of monsoon is more pronounced on agro industries, fertilizers, pesticides, seeds, and edible oil. Subsequently, the demands for other manufacturers' goods also go up. War. A war between two countries will have a negative impact in money value, profits, and stock markets. A war between India and Pakistan will have negative impact on both countries. If a war occurred between India and China, then it is a total disastrous. Every war is a destructive one and economically wasteful. In the year 1999, Kargil border dispute, India lost some 1,000 crores of money. Post-war inflation will be high. Taxes will go high to make up government expenditure. The purchasing power of people will come down lower and aggregate demand declines, so company profits will become low. Investors' losses will be heavy. The recent Gulf War towards Kuwait rescue from Iraq proved that such external conflicts could also have disastrous economic consequences for India. Even though we have not participated in the war, high petroleum prices eroded our money. Inflation. We have discussed about inflation in a separate chapter. Inflation erodes the purchasing power of money. Inflation is nothing but every year price rise calculated as a comparison of previous year price. In advanced countries like USA, UK, Germany, France and Japan, the inflation rate are below 4%. In India, before 1990, inflation was 10% to 12%. Now, the inflation in 2000 is below 5%. We are going well, but the realization in full may take further 5 years because still the prices are higher due to withdrawal of subsidies and concessions, which are not accommodated in inflation. The stock market will march steadily with low levels of inflation. Foreign exchange reserves. A developing economy like India needs foreign exchange for meeting balance of payments deficits. We need earnings from exports, capital inflows, and loans. Unfortunately, our foreign exchange reserves declined low after the Iraq-Kuwait Gulf crisis war. The IMF has helped us to improve the reserves by timely loans. In 1991, the new economic policy in India, a lot of foreign investments were invited instead of high loans and increasing interest burdens. After the new economic policy to countries' foreign reserves to enormous level and we are in comfortable day when comparing before 1991 year. The Indian stock market improved and the number of Bombay Stock Exchange listing companies rose to 6,000 from 1,200 after 1991. Public debts and foreign debt. Public debt seems high in India company to advanced countries. In India, money market development is very poor. In UK, money market seems well stabilized, even better than USA. The Lombard Street in London is tops than New York money market. In India, there is no liquidity for sale of debt instruments. Now, Indian government introduced DFI, Development Finance Institutions like ICICI, IDBI and IFCI, etc. These are directly controlled by Ministry of Finance. The above debt instruments are easily saleable in stock exchanges and one can enjoy a high security in investing of DFI bonds. There are also many other company fixed deposits. Now our stock market is well improved. With the liberalization policy, Indian companies collect bonds from various international markets which are also having good liquidity. Please watch the next video for continued information related to the same topic. I hope you liked the video. If you liked the video, don't forget to like and share. Keep practicing, keep learning, keep growing.